Mira Business FM. The sound of success.
It's Mira Business FM. It's the morning drive. Saudi Arabia is seeing a major rise in new business activity, particularly across tech and finance and construction and the manufacturing sectors linked to Vision 2030. The kingdom has also issued 188 new industrial licenses. This was for the month of March 2026, driving over 1.81 billion Saudi riyals in fresh capital into the kingdom. So continued momentum in investment and development. So plenty of questions to ask. What's driving the surge? Where is investor demand strongest? And what does this rise in business activity say about confidence in the Saudi economy? And more. Hopefully to answer those, James Elliott Square is from Sovereign PPG Corporate Services and joins me in the studio. Good to see you.
Nice to be here. Thank you for having me.
Big long introduction, lots of questions to ask you. So it's going to be quick fire.
Yeah.
Relatively speaking. The thing about this, James, is March was clearly a pretty big month for the kingdom from a tech, manufacturing, specialized finance. It's a pretty full pipeline. Are we looking at a temporary spike here, or is this like a new baseline for business activity?
I would say on a high level, a baseline.
Right.
You don't set up a license overnight in Saudi Arabia. However, we've seen an increase trend on a more than a linear scale, a significant increase.
Significant upwards.
Over the last 6 months, year, 18 months. It's continually increasing every month.
What's driving it? What's behind it?
I think you hit the nail on the head. Vision 30, having a vision and a concept and understanding where you want to go gives confidence in the market, and any confidence in the market drives. We've got the premise and the understanding of what the UAE have done, and then over the last 5 years, with Saudi getting their ducks in a row after COVID, making it easier to get into the market, they've seen a huge increase. Alongside sovereign investment, they've got the stability there, the confidence is in there in the market, and they're not just oil driven. They're now diversifying into lots of different markets.
Let's delve into the figures a little bit. I mentioned 188 new industrial licenses in a single month. I think 78 new factories actually turning on machinery, if I'm right. So when you look at the pipeline at Sovereign, what specific structural triggers are driving the speed of the transition? You know, going from the plan on paper, if you like, to actual physical manufacturing.
Well, I think it's a long-term game. Anybody looking to go into Saudi Arabia are certainly not looking at the short-term gains, and that's why I think we're in a strong position. I say the proverbial Saudi Arabia are in a strong position because they're not looking just to quickly get a company on board into Saudi in the next month. They're looking at, as I said, the 2030 vision, which has been there for over 10 years. And when you're looking to get into Saudi Arabia, you've got to look at so many different factors. So it's probably a 1-2 year concept rather than, right, let's pull the trigger.
There's a feeling to me. I mean, we talk a lot about make it in the Emirates here, and it seems to me there is a similar shift in Saudi. So, you know, moving away from kind of the standard light assembly to the more heavy tech-enabled domestic production.
So there's intricacies around industrial. So in Saudi Arabia, compared to, let's say, the UAE, where people might be more familiar with, the wholesale trading part is actually quite hard to get into. It's quite a high bar to get into Saudi Arabia. Why that's being kept is several reasons, but one of the main reasons is they want investment in country. They want to be dependent on themselves, not elsewhere. So they're trying to drive investment into the country through industrial means. They want foreign companies there to build their factories, to invest in the country, so that the equipment, whatever they're manufacturing is there in country, and they don't have to import it.
You mentioned Vision 2030 and made the point that it's a decade old, isn't it now? But it feels almost as though it's being viewed through a new lens at the moment. There is such an investor focus on Vision 2030. Am I reading it wrong? Is that?
I think it's a combination. I think where you start is you have an ideal, and that vision never stays still. I think they're always evolving. I think we've seen that in some of the projects that are happening. Some of them have been maybe shortened and become a little bit smaller. Others have kept where they are. Suddenly, the World Cup 34 is in play as well. That's going to drive a lot of interest into the country, not just investment, but long-term vision. So there's a lot of excitement there. The vision of 2030 in itself was the precipice of starting, and they've evolved along the journey. They've made things easier to invest into the country. They've made a lot of incentives to come into the country with big projects or awards. So initially, money probably drives it, and then when people from abroad and see the opportunity as well, there's not just a short-term solution. It's actually, we need to be there long-term because there's a real good opportunity to come into an emerging market, let's be frank, even more emerging than, let's say, the UAE, which has been around for 50 years, or say 25 in business. There's a real opportunity to get your foot in the door and start making inroads in the Middle East.
So there is. And, the World Cup in Saudi is just 8 years away. That's kind of next week at this point in my life. That's how I see it anyway. So Vision 2030 casts kind of quite a wide net, right? But money, I think money behaves mechanically, right? It goes where the path is clearest and where the yields are at their highest. Beyond the manufacturing boom, where is the pipeline showing the most aggressive demand at the moment? Is it a pure tech play? Is it infrastructure, plumbing, as they term it?
I've seen over the last 2 years specifically, AI and technology is huge. Yeah. Now, wherever you go in the world, it's exploding. Okay, maybe I shouldn't use that term right now.
We can edit that. That's fine.
I've also seen a big influx in real estate. Now, foreign investment is being allowed in certain areas in Saudi Arabia. It's not as wide as the UAE. Obviously, the UAE real estate market since 2003 has been freehold in many areas. In Saudi, it's a little bit more limited, but it's opening up. So we've seen more real estate companies coming in, brokerages and developers. So there's no one sector, which is exciting. Right. Now you've got to also appreciate Saudi is such a larger country than the UAE.
It's easy to forget that here, isn't it?
It's very easy to forget it. You've got a 30 million plus population. 65% as a very average figure under the age of 30. So you look forward to 2050 and your population is going to more than double.
Yeah.
So that's exciting if you're a foreign investor because there's opportunity. So what we'll see is we'll probably see a staggered approach where we're seeing a lot of consultancy initially because of obviously the projects. We're seeing a lot of consultancies because the government wants to make sure they get things right. We're now seeing real estate. We're seeing obviously tech. And alongside that, what we're going to see probably towards 2030 is more retail, more wholesale, because you're going to need to be able to fund all the people coming in, whether they be foreign or they be local.
Broadly, in terms of industries, where's the strongest growth right now?
I would say technology.
Really?
Yeah. I've seen a lot of AI. As most of us will know, AI is strong here. There's a lot of investment. There's a lot of the technologies that are coming out of here and raw materials. Oil is obviously a big factor of that as well, having the cash flow to be able to do that. So I would say technology is probably the big one, but there's quite a few others closely behind it.
Okay. It's interesting, the data center thing, isn't it? Because they don't last very long. So it's this consistent approach that's needed. How that works, we wait and see. How important are the giga projects and infrastructure spending to trends at the moment? Much in the news.
I mean, they were critical initially.
Yeah.
Critical. To be able to get the buy-in by foreign investors, you had to create a buzz, an excitement.
Sure.
And I think the confidence is still there with the giga projects. They are being built. We're seeing with the Line projects, etc. Neom, it's happening. With 2034, with the World Cup as well, that's happening. So when you announce a project like that, if the confidence goes from that, everything else falls down. It hasn't. If anything, it's got stronger, and we're seeing that with the buy-in from foreign investment, where all around the world. By the way, we've got companies from America, the UK, Europe, Asia, Hong Kong, China. They're all investing.
People still buying into that vision. I mean, that's interesting to me. I don't follow Saudi as much as perhaps I should, but I read the news. I look at the question marks over some of the giga projects. That's an interesting statement, I think.
It is, and you've got to take things with a pinch of salt sometimes.
Sure.
And you've got to say, right, okay, look at every different angle. But what we're seeing with both interest, but also concrete interest, with actually people putting their money where their mouth is and investing, because it's not a cheap process to set up, and also you've got the ongoing compliance you've got to consider as well. So it's not just about dipping your toe in the market or in the water. And like in the UAE, you could probably set up a small free zone company here relatively cost effectively. And if it didn't work out, you could pull back out. Whereas in Saudi, that's why I say it's more of a long-term approach. You do your research.
It's more of a commitment, isn't it?
You do your research. You make sure that's what your vision is for your company, and then you go fully in. You don't just test the market.
Do you think there's a realization that it is a more realistic vision in terms of the giga projects now? Do you think there's a buy-in to that?
I think that's hard for me to say. I think there's.
But anecdotally, that's
I would say that was the reason why Saudi itself boomed,
Sure.
bringing the foreign investment in, allowing to own 100% foreign ownership in 2019 with the old Sadia, and now it's Misa. They made the process easier to set up. That drives confidence initially. Then when we saw the announcement of 2030 and the giga projects, people got excited. And then when they saw it actually happening, confidence was given.
Are more international companies choosing Saudi as a regional base?
So the RHQ project, regional headquarters, was driven nearly 2 years ago. It came into effect, and we've seen a significant increase of RHQs to be able to be awarded tenders, and that's really important. Differentiation. It was a costly process to do that, and because of that, it sort of filtered out the serious and the non-serious. You had to be pretty much in a place of enough revenue to make it worthwhile. The projects need to be enough value to make it worthwhile to come in as a regional headquarters. But the serious companies we've seen have taken that the bull by the horns, and they've gone for it.
Okay. If you just joined us, this is Mira Business FM from Dubai. We're talking to James Elliott Square, who is the Commercial Director of Saudi Arabia for the Middle East, actually, for Sovereign PPG Corporate Services. What does the rise in industrial licenses tell us about the economy in Saudi, James?
It says that there's enough space on the floor.
Okay, good to know.
No, so there is the difference between Saudi Arabia and, let's say, the UAE is they've got so much more space, right? So they've got designated areas for industrial purposes. So they're not having to, if you compare it to, in the old days in the UAE, you look at Al Quds, there's a lot of industrial there. right? Whereas in Saudi Arabia, they've got areas, specific zones, areas where that you have to take industrial space. You can't go into the middle of Riyadh, for example, and then have industrial parks. So that's good. What it tells us is that there's confidence in the market. I keep using that word confidence because I think that's huge in an emerging market. It shows that there's money there, and it shows that there's enough people to actually buy the products that are being made.
And it's easier to launch a business. I get that there is still red tape and it takes more time, but it is becoming easier, isn't it, to launch a business?
For sure it is. When we go back to, let's say, 2018, 2019, when Sajia was first coming into play, it was a lot more tricky to navigate. When COVID came about, which is obviously not something we like talking about too much, Saudi Arabia, I think, came out of it glowing. They brought the government departments together. They got their heads together and they got their ducks in a row. And when they came out of it, it was chalk and cheese. Suddenly, we were able to know the process, explain that to a foreign investor in layman terms, and that's critical in my opinion. Being able to explain it to someone and understand, right? Okay, this is the step process, and it's not vague. It's pretty direct, pretty transparent. Yes, it can take time because in an emerging market, there are going to be nuances. It does take time, but it's understandable, each process. So it's something that when you're looking to, let's say, go into industrial compared to trading or compared to a professional service, you know the step plan for what you need.
Okay. It's remarkable how well this region came out of COVID, I think. UAE, Saudi Arabia, across the Gulf. What sectors are expected to grow fastest through let's say, the rest of this year? What do you think?
But I think you're touching on that. I think that's quite an important point. Why did the Middle East come out of COVID so well? I think that's with a vision, understanding where you want to get to, but also being able to make decisions quickly for the betterment of the region. Whereas if you look at the Old West, well, I don't want to get into too much geopolitics, it takes a lot of time for change. Whereas here, we can make decisions quickly.
Well, that's the point, isn't it? I mean, if you take the example of where you and I are from, things never seem to change. We kind of rehash things, and then one bunch undoes the rest of, So I get that. No, it's a decent point to make. What was that? Yeah, what sectors are going to grow fastest for the rest of this year, do you think, in Saudi?
Technology for sure is going to continue to boom. Real estate is going to gain more and more confidence, and I wouldn't be surprised if they bring out some more rules to make it even easier. They obviously have to be careful in certain areas of Saudi for religious reasons, like Medina or Mecca. But apart from that, I think they're going to be opening the book a little bit more to get more foreign investment. I think those are the two big markets. Industrial will continue for a steady increase. I would have thought. Cybersecurity is always at the forefront of your frontal lobe, because you've got to make sure that whilst you're doing technology and AI, you've got to make sure that you keep everyone safe. Now there's a lot of financial companies coming in as well, regulated with the CMA. So then cybersecurity also comes hand in hand with that.
Sure, particularly at the moment as well. Let's use the word that you've used a few times in this interview, that word that begins with C, confidence. Investor confidence, stronger than ever, I think, probably fair to say.
It is, because I think it's a long-term vision. Yeah. We're not seeing the uncertainty in the market. There's a clear vision of what they want to achieve and where they want to go. And a clear timeline on it as well. It's why we're not seeing, in the regional issues that we've had over the last month or so. We haven't seen a huge dip, because they're understanding that it's 2030, 2034 and onwards, not what's happening in March or April. Yeah. So I think that's the key. Is the communication of where we're trying to all go towards, not hoping and crossing our fingers.
That's the key, though, of these visionary goals, aren't they? These plans. It's just common sense, something to aim at.
common sense, but also they have the backing as well, remember?
Yeah.
So they've got the financial capabilities to back what they talk about. So it's not just talk and no trouser. They've certainly got the trouser.
I like the allusion there. So look, entering a market like Saudi, it's not just about having an aggressive sales team. It's about navigating corporate architecture as well. If you're a founder here in the UAE or a global founder maybe watching or listening to this, and you think, I want to get a piece of this momentum. This is interesting to me. What's the biggest blind spot in terms of compliance?
Yeah.
That you may face if you were to try to set up?
I think there's two aspects you need to really consider.
Right.
Okay. The first one is tax. Now, we live in the Middle East, and we are sort of understanding that, or a lot of people's perceptions of the Middle East is that it's tax-free.
Sure.
Okay. So in the UAE, it's not tax-free. Although we pay no income tax, there's corporation tax, there's VAT. In Saudi Arabia, it's even more so. So in Saudi Arabia, the VAT is actually at 15% rather than 5%. Corporation tax is 20%, okay, which is a lot higher, significantly higher than here in the UAE. There isn't any personal tax, but there is also withholding tax. So what you need to understand is when you come into a market is how do I potentially get my money out of the market once I've made some, okay, especially for a global company. So you've got to take into consideration things like transfer pricing. You've got to take into consideration how do I repatriate monies if we want to. So that's where tax advice is very important. You really do need to consider that before you enter the market and not get caught short. You need to make sure who's going to file, who's going to do my bookkeeping, because local bookkeeping has to be done in Arabic, okay? It cannot be just done in English. It needs to be done in local currency. So again, who's going to do that for me? How am I going to navigate the portal system? Now, there's a lot of portals. I don't want to go too intricate here, but there's a lot of portal systems. Every government department has a portal, and you need to be able to make sure you are compliant on those, both in renewals and submissions and filings. So that's the first consideration. The second consideration is understanding exactly what you're going to do in Saudi Arabia. Like in the UAE, you have activities, and those activities will determine every single requirement that is upon you for both setup and ongoing.
Some good advice there. The portal advice in particular, how to navigate your way through. James Elliott Square is Commercial Director for Saudi Arabia. For the Middle East, for Sovereign PPG Corporate Services. It's been good to talk to you. Thank you.
Thank you very much for having me.
Appreciate it. More interviews, highlights coming soon. Check out Mira Business FM on YouTube, on Instagram, and you can also stay up to date on mirabusiness.fm.
Mira Business FM, where business comes to talk. Mira Business FM, where business comes to talk.
It's the morning drive. Real estate now. Easy payment plans is the topic this morning. An attempt to decode developer payment plans with AJ Menon from Lux Vista Real Estate, who is our regular Tuesday morning guest, and it is good to see you.
Good to see you, Tim.
Nice to have you here. So I want to get straight into developer payment plans with you because this is, well, you're the man that knows. Not all plans are created equal.
Not
AJ,
at all. Yeah.
I think. Depends if you're an end user or an investor.
Depends, yes.
Right, yeah.
Yeah. See, a bit of caveat here. That's the best way to put it.
Yeah.
You know your financial position better than anybody else in the world.
Or you should.
And you should. Or you should. Or you should
You should know it.
come back to Mother Earth. Reality.
Yeah, exactly. Yeah,
Right?
yeah. Just
So
in case.
let nobody, lure you into anything. You understand it.
Yeah.
So you must choose a payment plan that supports it.
That makes sense,
That's
actually.
the basic 101 for investing in an off plan.
It's very easy to be sold,
Yes.
these things aren't. Okay, so if you're an investor, for someone buying a home to live in, an end user, what type of payment plan usually makes the most sense?
I would go for a balanced payment plan. I will come to that. But I would like to take a mortgage at the end of the construction phase.
Right.
Because and spread it to a long period.
Okay.
So you can actually have a decent lifestyle along with owning a property.
Gotcha.
Right? If you are an investor and you are looking for to flip it at the time of handover or rent it at the time of handover, then probably a different set of payment plan might be better for you.
Okay, so I want to get to the details. I just very broadly wanted to set that out because I think those are the two camps, end user and investor, obviously. And my guess is, in fact, I know you're going to be positive about this, but you need a consultant. It's an important person to work with.
See, and decoding financial plans, our payment plans, is probably one of the most important reasons that you should be working with an off-plan consultant or a consultant for that matter.
Right. Okay. Let's jump into. Let me ask you one question before we go any further. Can you define an easy payment plan in the UAE?
Not really.
That's kind of what I thought because I've been thinking about this.
Easy for who? Easy for you? Easy for the developer?
Well, that's the first question to answer, isn't it?
Exactly.
Yeah.
So, and again, one person's ease is not the other person's ease.
Yeah. Okay.
And how do they define easy payment plan?
Yeah, and it doesn't automatically mean a better deal.
No. So, okay, we've heard all sorts of payment plans. We've seen that 70, 30, 80, 20, one person per month post-handover payment plan. See, like a 20-80 or a 30-70, that sounds very easy.
Yeah. Yeah, it does. Do you know what it is? Very often it's, you look at the plans, yeah, I understand those. And do you really understand those? Because I certainly don't understand.
Yeah, and many people do not. I mean, it seems to be a very simple thing on paper.
Yes.
But if you really ask a little bit more, you dig deeper sit with your client and ask them, they have no clue how it works.
Okay, so we're getting to the meat of this now. So there's a great deal of, it's a kind of a marketing versus reality thing, isn't it? So you have to understand, hence the need for the consultant.
Exactly.
So let's look at the pros and cons of the different payment plans that are available, because there are all sorts.
Yes,
Where do we start?
And let me also tell you that it's not just the clients that they don't understand the payment plan. There are some consultants, they don't understand the payment plan.
Okay. So if that's the case, you need to do your due diligence is the phrase.
Correct.
Right.
And see, I will tell you with the first one, which is like a front-loaded payment plan.
Okay.
What does that mean? You have to pay, it's a 70-30 or an 80-20 payment plan, which means you pay typically 70 to 80% of the property value during the construction phase.
Okay.
And the remaining on handover.
So there's a good side to that and a bad side to that.
Yes, definitely.
What's the good side?
The good side is that there is zero execution risk. The developer has all the money. He will definitely complete it. Absolutely no problem.
Right. Okay.
Right.
Okay.
And also, who are the investors? I mean, the investors investing into such projects or products are very cash-rich people. They have the holding capacity, so they're not going to, if there is a market shock or something, they're not going to exit. They are going to be there.
So this is not a speculative
No,
investor.
these are all
type,
either
right,
they are an
right.
end user or these are people with deep pockets.
Got you.
So what that means is basically your property will hold value and it will appreciate on handover.
Okay, so if a front-loaded payment plan is the way to go, you're looking at this is the big league, isn't it? This is the
big league,
top tier of government, I guess. Yeah. Okay.
And that is also the negative aspect of that, because you need to come up with that kind of upfront capital.
Well, 70%, 80%, yeah.
For many people, it's not possible, because in the next 2 to 3 years, coming up with almost 70 to 80% of something like a 3 million or 4 million, unless you have a good savings already with you, it's not, because remember, you are going to keep paying your rent as well.
That's a good point. Okay. All right then. So that's a front-loaded payment plan. 70-30, 70-25, 80-20,
Yes.
usual splits.
Yeah.
What about a back-end loaded payment plan? Is that the right phrase? That
It's a backloaded plan. You can do back-ended.
Okay.
Yeah. And before I complete this, because when you're buying that the other one, the previous one, the front-loaded, you should make sure that it is coming from either a government-backed developer or a top-tier private developer, because you are buying a product that you have not seen, and after paying 70 to 80% of it, you don't know the product.
Okay, so there needs to be, you need the confidence,
You need the
or
confidence, yes.
there needs to be track record. Right, okay, got you. So the back-end loaded payment plan, we need to give this a catchier name, AJ.
See, that is basically a 20-80 plan or a 30-70 plan, which means you pay only 20% or 30% during the construction phase, and the remaining is on handover.
Okay.
This is the most dangerous payment plan. If you really, it looks the easiest, but it is the most dangerous payment plan.
Well, on paper, to me, it seems more attractive.
Exactly, and it's if it is attractive for you, it is attractive for all the people out there in the world.
That's very true. Yeah, no, and do you know what? That's a really good point. That's a really good way to think, isn't it? Because I'm no different to anybody else. You're no different to anybody else. We all feel, things in similar ways.
Suddenly we feel that, maybe we could buy this. And then at that time, we are not really looking at what is the real cost of the product. So the only thing I'm looking at is like, okay, it's a 3 million product. Maybe I can do 750, 800. Yes, maybe I can get away with it.
You end up talking yourself into it, don't you? Because you've seen, that's such a great kitchen or whatever. Yeah, no, that actually, and that's very much a part of real estate decision making, isn't it? The emotional aspect.
And this is also being used by a lot of brokers to do this. And this is exactly what is wrong with this industry. Because I've seen people, I've seen brokers, luring in you to say, what they will tell you is, what, with this kind of amount, I can get you 3 units. What I will do is I will send 2 units within the next 3 to 4 months, while it is still under construction. And with that margins, your primary investment becomes almost free.
And in your head, you're becoming a real estate
exactly, and that's
mogul.
Exactly, a portfolio without having the capacity to have a portfolio.
Yeah, okay.
And this is almost impossible. I mean, I thought this is not happening because obviously it is very, very difficult to sell off-plan resale.
Yeah.
So, and I saw during an open house very recently, a broker was telling this. I will sell you this within the next 3-4 months. Buy 3, and you can easily, own the other one with almost the margin. You're just paying marginally some amount. That's about it.
So it's almost 3 for the price of 2 is the pitch.
No, you buy 3.
Almost.
Because obviously, if you have 60% of money with you for 1 unit.
Sure.
So if it's a 60-40 payment plan, yes, you can manage that payment plan. But instead of 1 unit, he will say, okay, you know what, you have 60% of the value. Let us buy 3.
Yeah.
So you pay 20%, 20%, 20%.
Right.
And before the next installment, let me just sell you at this the other 2 for a premium, so that premium comes into your first property.
Right.
Understand?
Yes, I do. Yeah, yeah. I'm with you.
And even at this day and age, I saw that guy signing. The client was lured into it. I was shocked.
This is, how recent is this?
A couple of weeks back.
Wow. Okay. Well sold, I suppose. I don't know, but
I mean, you must have zero ethics to do this.
that seems, well, it doesn't sit well.
Exactly.
I've got that kind of pit feeling in my, that's wrong. Okay, so if you're of a speculative nature, a back-end loaded payment plan is
Is perfect for you.
right.
Yeah, and that is also another problem. There's a lot of speculative investors who will be investing with you in this project, and any sort of incident that happens, like whatever happened now, these are the first people to exit. They will say they will sell it at whatever price available, whatever they can get, and then they will exit out of it. Once they do that, that price gets recorded in the DLD. And your project, your unit cost, actually, it loses the value on handover.
And that has a very real impact on the market.
Very real impact on the market.
Okay. No, right. So I understand that. So that could be the difference between,
a good investment and a bad investment.
it's as simple as that.
It's as simple as that. And another one. What is the guarantee that at the time of handover, you're going to get 70 to 80% of the project cost as a mortgage, if you are planning to take the mortgage?
Right.
Because there are a few things. The banks could always adjust their loan-to-value ratio.
Mm-hmm.
The banks could also assess your property or project at a lower price if there is a lot of oversupply suddenly comes into that area. So suddenly something that you bought for 2 million, even if it becomes 1.85, 1.9, the 70% of 2 million is not 70% of 1.9 million. And you only have you've calculated that money. Okay, by the time this thing, I will take 80% loan and I will just, I'll pay off my mortgage. That might not happen. So suddenly you will need some extra capital from somewhere.
Yeah. And that's a scramble.
That's a
last
scramble.
minute. Okay. So if this is an offer from a new developer or a proven developer, there's a big difference there as
Big
well,
difference.
obviously.
If it is a new developer, execution risk goes immediately high. Number one, they should have solid financials, and we do not know if they have solid financials. That is, again, the reason why you should be talking to a consultant. Because as a consultant, you are actually going very deep into the developer's history, if the developer is not from here, maybe the developer is from a different country and they've done 15, 20, 30 projects out there. Yeah. So that is not really easily accessible for the general public. But the brokers, yes. The consultants, yes. We do, go dig deep into the background of the developer. Okay. But if it is from a reputed developer, proven guys here, what sometimes they might do is, they would want to launch a new project, but they will have, say, 4 or 5 old inventory sitting from the older project. Right. So they just want to get rid of it. So then they will say, okay, instead of your normal 60-40, it's a 35-65. Go.
Okay. Okay.
Jump on it. That's a good one.
Yeah. I mean, that's a nice little incentive, isn't it?
Yeah.
Yeah, okay. Just a reminder, you can find all our interviews or highlights of our interviews on YouTube, on Instagram, on LinkedIn, and AJ's face will pop up regularly, of course. What about, so those are the first 2 plans, front-loaded, back-loaded, basically. Mm-hmm. And I said to you right at the start, and you mentioned the balanced payment plan. So a 50-50 or a 60-40. Yeah.
I tend to move a little bit more towards the 60-40 payment plan.
Right.
It's even better because one thing is for sure. Rest assured, the project will get completed. Because they have already, once they start the escrow, they would have paid for the land already, and they would have put 30% of that project cost into that escrow account with ARERA.
Gotcha.
So with the next remaining 60%, which is coming in from the clients, they are pretty much 90% covered, and the remaining is probably the margin. So obviously, you will have your project done, delivered.
Okay, so this is kind of the safest plan, right?
Safest.
What do you need to watch for or look for with a balance plan?
There are some, even reputed ones. What they might do is they might ask for that 60% almost upfront. What do I mean by that? Is if the construction phase is probably around 3 years, their payment plan will look like, they try to get all the 60% within the first year or within 1.5 years. So you should look for a payment plan that is kind of stretched out, or that's the best way to do it. It has to be a construction linked phase.
Okay.
But it used to happen before. Some developers still offer it, but majority, 90% of the developers are not doing anymore.
Okay. So the best one is a properly spaced out payment plan, and the ideal is if it's construction phase linked. And that's very hard to find now.
So you pay 20% now, and they say, well, okay, the next 10% you're supposed to pay when the construction phase goes to 30%.
Right. Okay. I'm with you. Okay. You sent me some notes on this, and one of the sections is the 1% trap. Can you explain the 1% trap?
See, this again is a speculator's product. The people going for a 1% payment plan are people with less cash flow or less cash reserves. Any incident such as this happens, they will be the first ones to exit. They are very economically vulnerable.
Well, even I've got 1% of, well, might not, but even I've got a 1% possibility.
Yeah, so, and you should also understand that, if it is a 1% payment plan, you have some developers charging 1%, 1%, 1%, and on the 6th month they will say, oh, it's suddenly supposed to give me they call it a bullet payment, 6% on the 6th month or 7% on the 6th month. Suddenly it is not a 1% payment anymore.
What, so over the course of 6 or 7 months, that's probably nearly
2%
double.
each. Yeah, exactly.
Right.
It looks 1% on paper, but suddenly when that bullet payment comes, it's not a 1% payment plan anymore.
Right.
And you should also understand 5% every 6 months, which is probably what many of the top tier developers give, is a better payment plan than 1% per month, because 5% of every 6 months is 0.833% per month.
Yeah, okay. Right, so that's the 1% trap. There's another one, isn't there? A post-handover payment plan.
They just become creative all over the place, right?
I know.
Yeah. But see, again, post-handover payment plan is something that it helps a certain set of investors. What they're trying to do is they're trying to subsidize the payment, the remaining payment on handover from the rents that they collect.
Okay.
But they are exposed if the unit does not rent and it stays vacant for 1 to 3 months. They're very heavily exposed to that.
Yeah.
So there is no cash flow coming in, but your payment is actually much bigger. I would actually go for a mortgage because your EMI is much lower. Your monthly installments, which if you take a mortgage, is lower than the actual payment plan coming, post-handover payment plan coming from a developer.
Okay.
Because that rent that you collect can cover both the monthly installment plus the service charges.
Okay, so we have 5 payment plans now. Your recommendation?
It's definitely the balanced one. 50-50 or a 60-40.
Right. Okay. So let me ask you just a few. We've got a minute or two.
Yeah.
Just a couple of kind of practical advice questions. The role of consultants, really helpful.
Yes.
First of all, okay. Is there an example of somebody choosing the wrong plan and what it may have cost? Without names, obviously.
A lot of issues, because again, this happened. I know very many people have got stuck because of this. What they did was they bought a unit at the 2080 payment plan, and on handover, the bank said we cannot give you the mortgage for the money that you are asking for.
Right.
The value of the project went down, so they could not. They had to exit because they couldn't find the money. So that ends up as a distress deal.
I see.
Yeah.
Okay. Developers you'll often see post-handover plans, long-term installments, low upfront payments. We've talked about all of that. When are some of those things genuinely helpful, and when do they end up being a trap that we fall into?
No, see, if you again, from the good developer, if you're getting a 35-65 unit, no harm in taking it. It's a fantastic deal.
Okay.
So, but again, you have to be sure about the project. You have to be sure about the developer. So you need to have a little bit of information about the market.
This is the key, isn't it? And it goes back to the consultant again, or you doing your own It's
diligence,
all
yeah.
about due diligence and research. Okay. Final question for you, just very quickly, because I know we've got to go to next guest. But if there's one thing every buyer should remember about payment plans in the UAE, payment plans, or however I pronounce that, what would it be, AJ? Just the one piece.
It goes back to the first thing. It's like
Does it
you
really?
know what you can afford.
Right.
So you know your financial
Your
position.
financial situation that
Yes,
you should. Yeah.
exactly. And let nobody convince you otherwise. You know what you have.
That makes sense. Yeah, that's a good place to finish, I think. Payment plans. AJ Menon is the CEO of Lux Vista Real Estate, a man who always has something worth saying, I think. Good to see you. Appreciate it. A brief reminder, don't forget to like and to subscribe for more interviews and content like this from Mira Business FM.
Mira Business FM, where business comes to talk. Mira Business FM, your daily guide to the markets, money, and more.
A new cybersecurity report is raising, I was going to say alarm bells, that's probably a little bit alarmist in and of itself, but it's out, or will be out shortly. It reveals that 92% of organizations suffered identity-related breaches over the past year. And that's as AI and machine identities rapidly multiply. This morning on Morning Drive, we're joined by cybersecurity expert and identity security expert Lawrence Albana from Palo Alto to break down the growing risks facing businesses and why AI identities are becoming such a major security challenge. Lawrence, good to have you with us this morning. So cybersecurity isn't just hackers cracking passwords, tricking people with phishing emails anymore. Your new report's kind of shattered that assumption. Yeah. The twist is that the biggest threat isn't human error now, it's machines, machine identities. Yeah. But let's start there. What exactly is a machine identity, and how does that hack or exploit a piece of code, or how does an AI bot infiltrate an enterprise? How does it all work?
So basically, a machine identity obviously is not human, right? Yeah. So it still logs in like a human, except it's simply a machine. So consider it like a server, a bot, a script, and for every machine identity that's out there, it can actually create and administer automated tasks, right? Okay. So it can do things like you and I can do. Right, and behave like we can behave. But the most important thing is why they've become even more prevalent in society and how organizations deal with them, is that there's 116 of them to one of us.
Okay, so strength in numbers, you're saying. Right then. Okay, so as organizations automate and deploy AI, a breakneck speed doesn't even come close. We're going faster than that, aren't we? Yeah. Machine identities, so bots or APIs or autonomous AI agents, they're multiplying exponentially as well. Okay.
They are.
So your data shows that global organizations, let me get this right, now have roughly 82 machine identities. More than that, 100 and...
So it's a great point. If we look at the UAE, there's 116 per one person, and that's actually marginally higher
than the international.
Than the international, yeah.
Right, okay. So that's why identity-related cyber attacks are becoming such a major issue here. Because obviously we're more of a target, I think. Yeah. Is that what we're saying?
Yeah.
Got you.
And again, look, we're talking historically, you were managing humans, right? You're managing humans as an identity, but now it's machines and AI that you also have to consider as part of that play.
So the machine identities are having babies, basically, and
they are.
This is almost like a reproduction process. Yeah. Wow, it's remarkable. So how is AI changing? Can you characterize how AI is changing the sort of cyber threat landscape?
Yeah. So it's working both sides of the landscape, right? So on the attack side, it makes phishing, deepfakes, and social engineering like a lot more convincing, right? And if you look at it from that aspect, it's 100 times faster. So as an organization, you need to think about, the security teams, how are they able to keep up with these ever-changing movements? So I think what's important, AI is simultaneously a weapon that our attackers are now using to do such things in an environment from a security breach perspective, especially on identities, right? Because that's what it is. It's actually an identity that they're using, right? And the credentials they're using to manipulate these moves.
As though they're a person logging into your system.
Correct.
And it's just it. Okay. So in theory, if we need to be 114 times faster.
Yeah, 114, 116.
116. I mean, give or take one or two. Have we built a digital ecosystem that's just grown too big and too fast to be secure?
Okay, I think what we've built, AI has been there for a little while, but what we've built is we've built tools that help us accelerate, right? We've built tools. And the whole conversation is evolving around machines and AI, right? So what we've done, it's not just about what we've built, is we have a digital system that exists now where we can accelerate normal human tasks for the benefit of the company using these AI tools. Sure. And unfortunately, in the middle of that comes some susceptibility where, these can cause problems for security teams because you're not always in control of what they are doing unless you're monitoring them.
Right.
Okay.
Right.
And those can be any, like we spoke before about bots. It could be the use of LLMs, large language models that, even just innocent bystanders like us use for personal use, right? So these things are really important as well.
So we're struggling to manage AI or get to grips with AI, I suppose, and machine identities securely. We hear a lot about agentic AI systems, right? That don't just answer questions, but you can actually automate them to execute tasks or make decisions on your behalf, autonomous decisions, if you like. Particularly in sectors like, and really important sectors as well, critical sectors like utilities or logistics or finance. You've warned that this introduces like a new threat vector. So what happens if an autonomous AI agent goes rogue or in some way I suppose they can be compromised as well, can't they?
Yeah, I mean, I think that's the ultimate thing that I'm saying when I go to see CISOs, right? Because that's what they're worried about. Yeah. So often an AI agent, if you've used a couple of genres of industry, let's talk about finance, for example.
Oh, yeah.
That if you've got an AI agent in a financial institution, there's a possibility it could get access to the crown jewels, right? When we talk about crown jewels, things that are really important that could, compromise the company in great ways, right? So, for example, it might be touching customer data, right? If it touches transaction systems in financial institutions, that could cause a real problem if it's not managed correctly, right? So, and again, that can be replicated to many different sectors of the industry, like healthcare, right? So leaking of information, for example. So AI agents are touching sensitive data, and these type of things need to be controlled.
And continuously monitored as well. Because if you give, I suppose these are like elevated privileges, aren't they? But that could be the power to modify systems or some kind of privileged access. That means we've got to be watching more closely than ever.
Yeah, I mean, the ultimate goal, is for the security teams of these organizations to have a focus and understanding how, as you mentioned, how they're going to continually monitor that, right? Yeah. So you got your human identities, your machine identities, and your AI identities, right? And it's really important that you understand the role of each identity and what its limits are. And then a simple process is to control that and eliminate it at a certain task where it doesn't need to be used for anything else.
Right. Okay. So super strict protocols, basically.
Yes, for sure.
Yeah. Okay. So security by design at the outset becomes even more critical, I guess.
It does.
Right. And so every action that you take, you can audit every action, follow, I guess, that set of protocols to its conclusion, and then there would have to be super strict authorization controls. Is that how the kind of the chain of command?
Yeah, I think it's all about each individual customer, right? So basically, you have to identify, what the identity is doing, right? So it goes back to the simplicity of, here's the identity, what is it able to access, when is it able to access, how is it able to access, and what limits does it have? So you set out a control policy and process like that as a leader, and you need to be able to do that across the whole of your organization. And going back to the beginning of the conversation, the topic here is this 92% number we're talking about of identity breaches, right? So that's the type of vision and focus that needs to be handled by C-level security people.
In my head, I'm thinking it used to be just get a decent antivirus. That's just not where we are anymore.
Yeah.
What does this mean for critical infrastructure risk? What kinds of sensitive systems are under threat of access or infiltration, might be a better word, I suppose, in some ways, by a rogue AI agent?
Yeah, so the systems at work, you've got development operations in the cloud, right? So you have sensitive, software developers, workloads in the cloud that have sensitive information, could be financial, customer data. They have been administered to do tasks, right? To create accelerated outcomes, positive outcomes, nothing sinister. But unfortunately, because these are exploding so fast, you get into a situation where sensitive systems that we've just mentioned that are, potentially in the cloud, important workloads, they're not being monitored. So a governance policy needs to be put in place to manage these identities, right?
Okay.
And the reason that the conversation is important is because it just goes back to the growth of these identities. So in terms of human, there's growth in human identities as well, always year on year, always. But with identities, machine and AI, it's heavy, right? It's an increased amount. So that needs to be focused on.
Okay, so it's about having that conversation. And if you're not having that conversation, you should be.
You should be, yeah. Absolutely.
Okay. If you're listening via a podcast platform, thank you for choosing Mira Business FM. Are organisations, Lawrence, do you think organisations are underestimating risks linked to AI adoption? How do you view that?
Yeah, I think there are a few organisations that have a little bit of lack of understanding of the importance. So in the identity security stack that we talk about, an important aspect is, from the machine identity and AI space, there's certificates, right? Certificates act like an authorization to access a server or, an application, right? And as the years have gone on, those certificates that organizations use, right, they have to be renewed. And there's a policy that's come in now for organizations that, it used to be 200 days that you were allowed to renew it. It used to be 100 days. Now it's 47 days, right? And I think when you're talking about, do people understand? What I find when I'm going out into the market at the moment and speaking to security managers is that aspect of the business is something that they're not aware of, and it can cause some serious downtime if they're not on top of it, because a lot of companies at the moment are managing it manually, right? So it goes back to the ability to automate those things.
Right. Which sectors are currently most vulnerable to identity-based attacks?
Okay, so it's quite wide. Public, private sector, you're looking at government, oil and gas, finance, FMCG. It's quite wide.
It is wide.
And to be honest with you, a lot of people talk, it's more focused on the medium and large. I see it from all sizes of orgs, right? Because identity is it's not a narrow discussion.
Yeah.
It's a broad stack of not just solutions, of requirements. Right, so we see it a lot, obviously, from a compliance-driven market. So cybersecurity is heavily driven by compliance as well.
Yeah.
So again, financial services, oil and gas, government, FMCG, healthcare, all these type of businesses.
So if you're thinking in any way, it doesn't really apply to me. No, that's not. I'm not. It probably does. Don't be lulled into a false sense of insecurity, if you like.
Yeah, never. I mean, it goes back to, it just goes back to security gaps, right? So regardless of how small you are, whether you're a small, medium, large organization, you will be using identities. And it's really important also, again, to understand that cyber threats are coming from exposed credentials where a hacker is coming in not through your firewall anymore because he's got access to your credentials, right? And what we've been talking about so far, all of these pieces of discussions regarding AI, machine identity, regarding certificates and being able to automate the use of them is really critical in the identity security plan, right, for any C-level or security manager or organization.
Oh, it used to be, didn't it? That it was kind of people coming in the back door, almost. Now we're kind of ushering people in the front door and welcoming them and making them a cup of tea.
Exactly.
That's how it's working. Would you like some coffee, Mr. Hammond? So what? It's. I know it's really hard for you to give advice because all of these are case-by-case scenarios. But what would you suggest companies should be doing differently right now? Is it a mindset approach that's the first thing?
Yeah. So again, I think that's a fantastic segue.
It's the best I had at that point.
No, it's a great segue because the thing is we've spoken about, just to summarize, and we've spoken about quite a few things, right? We've covered quite a few topics when it comes to AI, machine identity, even humans, okay, on the identity part. But because there's so many moving parts, right? So some organizations, like you said, it's a case by case. But you've got, some medium organizations might have 4,000 people in the organization, which means that, okay, if they've got 4,000 people, how many machine identities have got? It's pretty large.
I can't even do the maths.
Exactly. So these type of things, in terms of moving forward, I think companies should start considering a single pane approach, right? Using a platform that helps them manage all of this as one segue to controlling their identities, right? It's not like yesteryear where it was just human and you're imagining privilege. So now, with Palo Alto, for example, we have a platform that enables a customer to onboard identities, manage them officially, and have a workflow and have an audit trail and be compliant in the way that they manage them. And most importantly, empower the customer to control the security in their environment with all of these identities, which is the end goal.
Well, I was just doing the maths while you were speaking there.
Yeah.
And if you have 4,000 people in an organization, that's potentially 500,000 machine identities on top of that, which, managing that kind of level in an organization of that size, that's a good few additional roles, isn't it?
It is, and I think the other thing is as well, right? If you look at 2025 versus 2026, it went from an average of 70 to 116. So what will it be next year, right? Because we're not at the peak of AI. We're just at the beginning, right? So it's going to be used more. I was in the coffee shop just now using it myself, right? And it's a company tool I was using, right? But it's well monitored and it's well managed, right? So I think in the grand scheme of the conversation, going back to the 92%, it's pretty obvious why it's happened, right? So the focus for customers now is to really look at how they're going to transform their organization into a level of control they've got. I think there's one more point as well, is that one of the findings in the report shows that over the last 12 months, 92% of UAE organizations have had 3 successful security breaches caused by an identity security breach, right? So it's critical.
Well, it is. That's a stark reminder, isn't it? Your report is not out yet, but it's coming out, isn't it? Is that right? Yeah. Okay, so it's in the next day or two. Very quickly, I'm interested in what an identity security guy uses AI for, but we'll maybe try and get that to the end in the coffee shop.
Sure.
Can we talk solutions? If a company realizes they're part of that 92% statistic that you mentioned there, for example, what's the immediate kind of technical change of course or pivot, whatever you want to call it, that you need to make? How do chief information security officers fix the position that they find themselves in?
Yeah, I think they just need to analyze. Let's say if you've got a customer that's had those potential breaches, just analyzing how it happened, and backtracking and just look at, was it to do with a privilege escalation? Was it to do with an access control? Was it a machine identity? And what they need to do is understand where that lies in their identity security landscape and what they have to do to fix it moving forward, right? Because like we said, every customer is different. So they need to sit, and if they haven't had an attack, they should still be looking at, identifying their security gaps at the moment as well.
Oh, you should be expecting.
Oh, yeah,
Surely.
absolutely.
Yeah, yeah.
Absolutely.
I mean, it's going to happen, whatever. All right, final question then. Lawrence, it's about, there's a balance to be struck here, isn't there? Because AI adoption has a huge competitive advantage, potentially, in business, right?
It does.
But it's also potentially a massive liability if it isn't grounded in identity security. That's what I've gleaned from this, potentially.
Absolutely.
So the days of the simple kind of firewall or, my antivirus point, that's gone. Now it's about who and what has keys to your data. And, you need to be the guardian of those keys, don't you?
You do, yeah. I mean, what you're saying is absolutely spot on, right? So I remember when I started in cybersecurity 20 years ago, and I was selling firewalls and antivirus. This behavior now that we're looking at, it's because of positive things that customers are doing, right? They're trying to accelerate, their revenue, their business processes. So they're using AI, they're using machine identities, using agentic AI, and those they're actually doing jobs that humans can do, right? But they're doing it 10 times faster, 20 times faster in some instances, whatever.
Yeah.
Right. So at the moment, in terms of your question, the pure focus for this conversation is that there's a high level of engagement that's required from customers to analyze what is the use of AI in their environment from an identity perspective, and start to looking at ways of how, from a roadmap perspective, how they're going to secure it.
Absolutely right. It's fascinating. It is. Lawrence Urbana is a seasoned cybersecurity expert. I read some notes about you, and an evangelist as well. It's apparently so, yeah. That's what they're calling you from Palo Alto. It's been good to talk to you. Appreciate you coming in.
Pleasure. Thank you for your time.
Good to have you here. If you enjoyed this discussion, give it a share and leave us a comment as well. This is Mira Business FM.
Mira Business FM. Mira Business FM, where business comes to talk.
It's the morning drive. Dubai has built a reputation as the world's fastest growing digital asset hub, and regulators are shifting their focus from basic spot trading to the high stakes world of crypto derivatives. So what is happening? Here, in a nutshell, is what it is. The UAE is strengthening its legal framework for digital assets. We now have version 2.1 of the Virtual Asset Regulatory Authority, VARA's Exchange Services Rulebook. And that's the UAE's formal framework for crypto exchange traded derivatives, or ETDs. So what are the legal implications of the regulations? What could they mean for crypto businesses operating in the UAE? For this week's edition of The Fine Print, Raymond Kiswani is back. He's a partner at Davidson & Co., here to break it down.
Good morning. How's it
As
going?
the kids say. Good, thank you. Nice to see you. So these rules, Raymond, have been available for, I think it's about 6 weeks or so. It's kind of the end of March, and they're designed to improve transparency and manage risk and give investors and companies greater regulatory clarity. This is a growing sector, of course. From a legal standpoint, what do Dubai's new crypto derivatives rules actually change?
Yeah, so I mean, from a legal standpoint, the biggest change is that Dubai is making crypto derivatives a more controlled or limited approval environment into a very formal, rule-based regulatory framework. So we are not just talking about buying and selling Bitcoin, for example, or other virtual assets on a spot basis.
Yep.
We're talking about more complex products, things like futures, options, and other kind of exchange-traded derivatives linked to virtual assets. The key point is that a platform cannot simply assume that simply because they have a virtual asset license that automatically offers crypto derivatives. They need the correct VARA authorization. They have to comply with very specific conduct, operation, and risk management rules. And it must be able to demonstrate that they have proper systems in place for margin, leverage, liquidation, etc. Legally, this creates a much clearer perimeter. It tells exchanges this activity is permitted in Dubai. We want you to be able to do it, but you can only do it in a regulated, standardized format.
Okay, so relatively major update.
Absolutely.
Then. I mean, it's a reshaping, isn't it, of how digital risk is managed. This is kind of a new rule book, really.
Effectively, yeah. I mean, this is one of the interesting things of what the UAE and Dubai have done, generally speaking, when it comes to all things virtual asset, meaning crypto, is that globally the trend has kind of been this weird thing of where either countries have not regulated it at all, or they've banned it outright.
Yeah.
The UAE has taken a much more balanced approach of saying, we want you to do it. We'd be happy to have you run it here. However, you're going to do it in a regularized regulatory framework for it.
Right.
The other unique thing that I think the UAE has done very cleverly is one of the main challenges when it comes to all things crypto is how do you treat crypto? Do you consider it a commodity, such as, for example, crude or sugar or currencies, or do you consider it a security? Because that kind of formulates how you try to regulate, and that's kind of the struggle that a lot of jurisdictions have tried to play with. The UAE has done something very unique in saying, we're not going to treat it as either. We're going to create a very specific framework for it. So, in ADGM, you had the very first virtual asset regulations that were passed. In Dubai, we have VARA, which is the world's first and only specialized regulatory agency only for virtual assets. So that I think has been a very unique thing, and that's why the UAE has seen such a flux of exchanges and firms wanting to relocate to here.
Yeah. It's certainly a line in the sand, and I suppose depending on your point of view, it's a crackdown or it's an institutional upgrade. And I wonder how people look at it.
Yeah, it's interesting. I mean, I wouldn't really say that it's a crackdown in the sense that anything untoward has been occurring here, but I think that there has been significant issues. Exactly.
Yeah.
And look, I mean, specifically for derivatives, this is a higher risk product.
Sure.
Naturally speaking, and so it does carry significant more risk to it. Crypto generally has this kind of love-hate relationship where people either love it or they hate it or they're completely misinformed about it, right? But it does, because it can be transferred very quickly cross-border, it inherently has certain cons to it. So I think that that's also kind of one of the bases to it is one of the main reasons that governments pass regulation, especially in the finance sector, is that above all else, you want investors to have clarity and to have certainty, and that gives market growth and that gives market stability. So rather than it being sort of a positive or a negative, I would say it's more just saying this is a reality. We can allow it. We can have it here. We can allow it to innovate and to thrive. But we're going to do it with a proper framework that is going to protect investors and not cause chaos or cause instability.
Let's look at one of the headlines that has people talking, the trading desk talking for sure. I mean, historically, offshore crypto exchanges allowed retail investors to trade up to kind of 50 times, right? Or even maybe 100 times leverage. VARA's new framework slashes that to a maximum cap of 5-1 for retail clients. So from a legal and I suppose a consumer protection standpoint, that's a pretty conservative line in the sand, isn't it?
Yeah, because again, I mean, if you look at the kind of the way that the global trend was going, that is a very, very high number.
Yeah.
An extremely high number. I mean, just to kind of put it into context, during the 2007-2008 kind of global financial crisis that was caused primarily by bad housing mortgages, those weren't leveraged anywhere near that amount, right? So yes, it is a line in the sand, but I mean, I would be hard pressed to find somebody that says that it's the wrong approach, given the sort of the size that we're talking about.
But the thing about it is it's real regulatory clarity, absolutely. And that's the key, isn't it? So it kind of goes without saying, but I end up saying it anyway. But that's hugely important if you want the digital asset, virtual asset industry to thrive and grow, and you want to create, an environment for that to happen in the UAE.
Yeah, exactly. Yeah, exactly. It's striking a very decent balance. You're not sort of saying I don't want to understand this. I don't want to see it happen because it's brand new. So I'm going to outright ban it. Yeah. Nor are you saying we're going to kind of close our eyes and let it happen without any sort of framework to it, and that will naturally attract bad actors. It is striking a very decent balance between allowing firms to innovate, allowing firms to enter the market, to thrive, to grow, but they're doing it in a proper fashion with oversight, with enforcement, with regulation that is clear and concise.
You advise Web3 firms, you advise crypto firms. The scale of, I think what's interesting about this as well is the scale of VARA's enforcement power. I mean, effectively, as a regulator, they could step in if there's market stress or there's an adverse market reaction. They can demand immediate position closures. They can alter margin requirements without any notice. So a crypto business now needs a compliance framework that's been designed to handle regulatory goalposts that could move pretty quickly, that could literally change in an instant. If there was, I don't know, imagine a market crash scenario, for example. But, you need to be ready for that now.
Yeah, it's really no different than if you were kind of a quote unquote traditional finance firm that was regulated by, for example, the SCA or DFSA or wherever you may be. VARA's enforcement capabilities and their actually is no different than any of the other specialized finance regulators. And again, that's kind of the way that you want to have it, because again, with virtual asset, they are assets and they are real money eventually. No different than if you were trading with a regulated SCA firm, for example.
Yeah.
So you do want so there is in many jurisdictions you are getting kind of more toothless regulation. You have regulation, but there's no enforcement arm to it.
Yeah.
I mean, without sort of, with the U.S., the kind of the white paper that's currently existing is to have it. The U.S. does this very interesting thing where they're one of the few countries where securities and commodities are regulated by two different regulators, and there's sort of this contest between the two regulators, and both the SEC and the commodities regulators aren't equipped with enough enforcement power to be able to take care of a market the size of the U.S. Whereas with the UAE, we do have many regulators around, but each has its own dedicated lane and its own supervisory powers and enforcement powers.
The rules, to me, outside looking in, this is going to offer a certain level of, security, a level of confidence amongst institutional investors and I guess global firms as well. It's a very positive development in that regard, isn't it? This is almost mainstreaming.
Yes, and I think one of the things that we always kind of have this weird debate of whether you need regulation or not, but I think the right regulation is very important, and I think firms do want that regulatory clarity, and the good actors do want it there because it gives them clarity as to how to operate. It gives them clarity on what to do and what not to do. It's really the untoward actors that don't want the regulation. But those that want regulation obviously want it to be for the right product, for it to be business friendly, right? So regulatory clarity is essential because uncertainty generally is one of the biggest risks within the finance market generally, but specifically with the virtual asset things. When businesses don't know if the product they're offering is lawful, whether a specific license is required, which regulator they're supposed to answer to, what compliance standards they're supposed to have internally. All of those things give firms a bit of uncertainty, but it also makes investors nervous about what legal risk they're taking on, what sort of financial risk they're taking on, how protected they are. So it's kind of everybody involved in the transaction. It helps when there is that kind of regulation. Ambiguity, often benefits the wrong type of operators. But your serious institutions, your funds, your custodians, they want certainty. They want rules to apply before they invest money, hire staff, onboard clients, and launch products. So, yeah.
What legal responsibilities will crypto exchanges and platforms now face?
There are several legal responsibilities that they're going to have. I think first is that platforms will need the right authorization. They can't simply offer derivatives as sort of an add-on to their existing business activity unless they have a specific license for it.
Right.
Secondly, they must assess client sustainability. This means that they need to understand whether a client is appropriate for this higher risk product, just because derivatives tend to be quite high risk as a financial product. They need to have proper margins in terms of leverage and liquidation controls. And this is critical because poorly managed leverage is one of the main causes of consumer harm that occurs in derivatives trading. And there's a requirement to have client assets and company accounts to be segregated. That reduces counterparty risk and will help protect clients if something goes wrong. And lastly, they have to be prepared for the regulatory oversight and the potential intervention. VARA has made it very clear that this is not a passive framework, that the regulator can step in during a market stress if there's any misconduct.
Do you think, our company is prepared for stricter compliance requirements? What's the word on the street, Raymond?
Well, honestly, I think some are and some aren't. The larger, more established platforms and firms will generally be better prepared because they already have kind of an institutionalized within their firm. Simply because they're already operating in a regulated market. So they already have compliance teams, they already have risk systems, internal controls, and structures built in. But your smaller businesses, your startups, possibly even international platforms that are just now entering the UAE market, they may underestimate the level of compliance that is going to be expected. And the UAE is often described as crypto-friendly, and that is correct, but it doesn't mean that it is a regulation light or a regulation-free zone. It means that it's business-friendly and you can operate, but there is regulation to it. So the companies that are prepared will be the ones that treat compliance as part of their business model, not just this is a thing we have to, do as a tick box approach. So having those policies, having those risk controls, AML systems will be necessary going forward.
Let's have a look at the competitive landscape, because what you say there is interesting. A crypto founder looking at the UAE basically faces three distinct regulatory philosophies. So you've got VARA on mainland Dubai, DFSA in the DIFC, and the FSRA in Abu Dhabi. So if an exchange or broker wants to offer complex derivative products this year, there's a choice, isn't there, to be made to make sure that you get the right legal jurisdiction without, getting too tangled up in, compliance red tape, I suppose.
Yeah, this is kind of the advantage and the disadvantage of the UAE that I think a lot of people don't recognize as much. It's the exact same thing. It's unlike many other countries where there is one sort of company house that you can form a company in and one regulator that you are regularized by. Here we have 7 different emirates. We have multiple free zones. We have 2 financial free zones, DIFC and ADGM. And you can kind of incorporate in any one of those jurisdictions. And you have various different financial regulators. You have VARA, which is a specialized virtual asset one. So, it can be overwhelming for those that don't really know the landscape or are trying to see where they can go in. But at the same time, it's a competitive market in the sense that each free zone is offering you a certain advantage that they are competing with another free zone because they want you to incorporate there. Right? So you effectively have that kind of consumer framework, if you will, that if you are looking to set up in the UAE, you effectively can pick and choose which emirate, which free zone, which regulator you want to be there. And this is kind of where having a good understanding of that landscape is crucial, because depending on what your business model is, depending on who your clients are going to be, what your services are going to be, that will dictate which free zone, which mainland, which regulator you should be under. Unlike, if you were, say, going to incorporate in Singapore, it's one place. You incorporate there, and there's one regulator, and that's it. Even in the US or in the UK, you only have that kind of one system. You don't really have a competition between them.
But the point of all of this is it's compliance, isn't it? I mean, non-compliance potentially comes at a heavy cost. You can't just get yourself a Dubai trade license, think that's a green light to go crypto, and because there are some heavy financial penalties, public censure, license revocations. That's the point here. Compliance.
Yeah, exactly. I mean, there's a lot of legal risks that are associated. There's definitely enforcement capabilities by all the regulators. They're not just sort of passive frameworks. They're not just passive rules. They do have enforcement powers, and those can be arranged from fines to withdrawing licenses to possibly referring things to criminal if it's warranted. So it's a very, very broad segment that can be brought about by the regulators.
And then tax and reporting as well.
Absolutely,
so that's another side of it. Do you think the framework that we're seeing, developing fast as well, could become a model for the region, maybe an international model?
I do think so. I mean, the UAE has kind of always been the first mover in the region, if you will, for a lot of things within the financial regulatory space, within free zones, etc. Other regional markets are probably going to watch closely whether the UAE can balance innovation, business friendliness with market integrity. If this framework succeeds, it could become kind of a regional benchmark, if not an international benchmark, for how to regulate exchanges and custodians and brokers, etc., within the virtual asset service, especially with derivatives, because again, it's a hefty issue because it is a very high risk product. So it's permitting it to happen because investors do want to be involved in it, but it is also providing it within a protected space. So the important point is that the model is not simply the UAE has open doors and will let everyone in. It's a licensing model with a supervisory expectation and enforcement model. That's likely to appeal to other regulators in the region that want to allow businesses, that want to allow the innovation, but they also want to prevent consumer harm, money laundering risks, reputational damage, etc.
Yeah, it's a balance, isn't it, between being innovative and being innovative in a realm that moves faster than certainly I can think.
Absolutely.
But it's that innovation, balancing that innovation with oversight as well. It's a very tough thing to do.
Yeah, it's again. I mean, this is kind of the problem that I think all regulatory arms have, is that law moves very, very slowly in comparison to the market, and regulators have a very difficult job of trying to regulate things within with clarity, and also trying to stay up to speed on how the market is evolving itself, right? So the framework again is not trying to ban crypto derivatives. it's recognizing that derivatives can serve legitimate financial functions, but it's recognizing that these products are high risk. Crypto itself is fairly high risk and can cause serious losses if they are poorly structured or sold to the wrong clients. And this is kind of where the regulatory direction is, that innovation should not mean the absence of rules or the banning of products, but equally, regulation should not be so restrictive that serious business cannot operate. And I think that that's where Dubai and the UAE is trying to strike that balance.
Yeah. A final question. I mean, this is an evolving space, obviously, and it's a fast-moving area of, I was going to say finance. I guess it is.
Yeah.
What should investors and businesses pay close attention to, do you think, in the coming months, for example?
Yeah, I mean, I think investors should pay attention to whether a platform is properly licensed, what products are they actually authorized to offer, how their leverage works, how margin calls and liquidations are handled, and whether their client assets are actually segregated. Those are kind of key things to look out for as an investor. They should also try to understand that regulation doesn't mean a product is risk-free. Right? A licensed platform is not the same thing as a guaranteed investment. Crypto and crypto derivatives especially remain high-risk products, but they are just regulated. And businesses should pay attention to VARA's rule books, their licensing conditions, their AML obligations, their classification requirements, and so on. Because the ultimate key message is that the UAE remains open to virtual assets. Innovation is wanted, but the next phase of the market will be more regulated, more compliance heavy, and more institutional in its nature.
Yeah. So the Wild West days are officially over.
Absolutely.
Gone. If you want to scale a crypto business in Dubai, it's playing by institutional rules, I think it's fair to say. Raymond Kismani is a partner at Davidson & Co., and that is the fine print this week. Thanks.
Thanks very much.
Appreciate it. Good to see you. As ever, don't forget to drop us a like or a comment or both, and subscribe for more interviews like this from Mira Business FM.
Mira Business FM, Dubai's home of business radio.